Good afternoon, everyone. Once again, I'm Gary Manchelenko with GMBA Advisors Group. We're going to get started here. It's 5 after 12, and I want to be respectful of everybody's time because I know it's pretty valuable. As you can see on the screen, there's my colleague there, AJ Newbaum. He is with the Principal Financial Group. AJ's been a great partner for me and my agency over the last number of years, and particularly as we try to filter through this paid family medical and trying to sort through what the state wants us to do and not do. And then also, I'll be perfectly honest, I don't think do a great job at letting us know that there is alternative options that are out there compared to what they have to present. That's part of the discussion that we're going to have here today to make sure that business owners know what their options are, that they don't necessarily have to be stuck with the state option, that there could be better ways of doing this. So with that, I'll just let you know, I've been an insurance broker for coming on 17 years now. Been in this this disability space, if you will, for the last 7 or 8. And so quite familiar with the process of what's going on. I've already quoted one group that's going to save $10,500 this year by not having to go through the state plan. So there's some real significant savings that that could be had. With that, I'm going to leave it with AJ to start us off. And I don't know, AJ, do you want to save calls or questions for the end, or would you want to take them as they come up?
Yeah, I think we're going to cover so much. It would probably be best for everyone to share your questions when it's topical, because as Gary mentioned, this is 100% educational. We'll take a deep dive into everything that's pertinent to you, your employer, and your employees. But I also want to give everyone a background, a little bit of context as to what got us to today. So by all means, please interrupt. I think there's a chat feature. So Gary, if you could run through those when necessary, I'd be happy to answer everything as it comes up. As everyone, I really appreciate the time. My name is AJ. I'm with Principal. I'm local to Denver and work closely with Gary and the team at GMBA. Fortunately, as he mentioned, there is a lot of moving pieces with this legislation, but because this isn't the first state to use this moving forward, we actually have a pretty good idea of what this looks like holistically. And I believe I just shared my screen, although we all had the pandemic to get good with technology. Can everybody see that? It looks like I might be on a different screen. Bear with me while I get that back. And
I have you, AJ.
You have me on the PowerPoint?
Yeah, I have you on the shared screen.
Perfect. Well, we will move it over here. Can you see that now, Gary?
No, it is gone.
Okay. Like I said, work in progress. But I did take this today as the 9th because if any of you have been following along with the legislation, you might have noticed things have changed. In addition to the fact that not everything was laid out when we were all defaulted into this January 1st of 2023. The first thing I always preface with these is that Principal and the other insurance carriers in the industry will call this a paid family medical leave product, where the state legislature is going to call it Colorado Family. It's important to note those are completely interchangeable terms. It's just a difference in jargon between insurance carrier and what the state government wants to call it. But if you hear me call it PFML, that's abbreviated down from paid family and medical leave, or Colorado Family, you're on the right call. We're going to talk about the right things. So as I mentioned, there is a little bit of behind the scenes to get us to today. We're actually the 5th state to pass a paid family and medical leave policy. The others were Massachusetts, Connecticut, Washington, and Oregon. And if you'll note, those are all on the coastal sides, which is typically where we see these types of legislation being passed first. So Colorado is kind of breaking the mold in the fact that we're the first to adopt this, but we're not going to be the last. In fact, there are 15 other states going through a similar legislative process to bring this same product to those states. So this isn't going away anytime soon. Every state will have different legislation as they see fit. So what I'm going to tell you about is specific to Colorado, but we can draw some comparisons long-term with what we know on those other states. With that being said, today I want to cover the full scope of eligibility, plan design, and cost. And we'll kind of go about this in a 2-prong approach. Those first 3 bullets will be everything relative to the state. It's almost a cut and paste. I'll give you some context to it. And then we'll pivot about halfway through to what Principal in the insurance industry is able to provide you as an alternative. Because just as Gary mentioned, we're all in the same boat that we have to follow and play by these rules, but you don't have to move forward with the state. You do have options at your disposal. So if nothing else, take away the education from this and understand there could be a solution for you. And that's up to Gary and his great team to help find you those solutions. So talk about this product in specific. I wanted to set the scenes. I'm sure everyone has a different understanding of this, where your typical medical or ancillary products are designed for full-time members, most likely within hours of eligibility of 30 to 40, again, just to capture those full-time members. This product's eligibility is a little bit different. So instead of hours worked per week, this is going to look at the income these employees have received. So on the top left-hand side, you'll see that the employees are defined with those 3 bullets, and it's any employee that makes $2,500 during the base period. 2,500, excuse me. Base period being defined as the last year, essentially. So what that means is the earned income doesn't have to be from the same employer, as that last bullet in the bottom left calls out. So if we think about this logically, once we get to that January 1st, 2024 date where the benefits are actually eligible to be used, as you hire part-time members throughout that year, if they've come from a different employer within the state of Colorado, you're going to be required to cover them day one. That income threshold doesn't reset. So it essentially makes all part-time and seasonal employees also required to be covered, which is a key difference with what your medical and ancillary eligibility looks like today. This product offered from you, the employer, to your employees. These employees can use this product on themselves as well as their family members. So I've defined family members on the right-hand side, and I think you'll all find those first 4 bullets are all pretty reasonable and very easy to follow until we get to that last 5th bullet. Any other individual with whom there is a significant personal bond. I don't see any cameras on, so I can't see everyone's eyebrows raising like mine did when I first read that, because I don't know how anyone is going to necessarily be able to put that inside of a box, right? It's pretty gray in the sense of how can we measure a significant personal bond? I did do some digging and contacted the state's actuaries team. So I have a little bit more to uncover with this in a couple of slides when we talk about the plan design itself. But your main takeaway, all part-time, seasonal, full-time, Colorado-based employees will have to be covered, and your Colorado-based employees are able to use this product on themselves or their family members, so long as it fits the definitions I have listed here. So when I was first kicking off the meeting, I mentioned every state will have different legislation. So because Massachusetts was the first to enter the market, they created this as they saw fit. And then when Connecticut rolled out, they get to pick and choose what they think Massachusetts did right, make small adjustments as they see fit, and every state will follow suit with that. So Colorado has taken those other states and has made a few tweaks that'll be specific to Colorado, essentially meaning no one has an enforced policy checking all 3 of these boxes off. Everybody's offering this new product together. This product itself will cover 3 different leave types. It'll cover medical leave, family leave, and safe leave. Medical leave, you can all think of as a disability policy. So it'll cover the employee's injuries and illnesses if they're unable to work. This product will also cover family leave. We just defined what a family member is, but the actual use of this product is to bond with a newborn child, take care of a family caregiver, such as a mother, father, even grandmothers or grandfathers could qualify as a family caregiver, or spend time with anyone being called to active service, military exigency, as you'll see on that 3rd bullet. Finally, what's unique to Colorado is that no other state has covered safe leave. So your employees will have the ability to use this product on themselves or their family members if there's any domestic violence, stalking, sexual assault, or sexual abuse. A very well-rounded product, very employee friendly in the sense that this covers a wide variety of different reasons an employee would want to go on leave. As an employer, it's important to keep in mind that bottom blue font. Job protection will apply if the employee has been at their job for at least 6 months. So what that means is if an employee is new to your company, files their first family claim next year when the benefits have rolled out, but they have not satisfied their 6 months, it means you don't have to keep their job. In fact, it means you can actually terminate them they'll still be able to follow through with their claim, whether it's through the state or through an insurance carrier, but they're no longer on your payroll. That's different than when they hit that 6-month threshold, because they'll have to have their job or a job that they're reasonably trained and qualified to perform at their disposal when they return from their claim. Similarly to FMLA in that sense, it's also designed to run concurrently with FMLA. There is a little bit of guidance that the state's given on temporary employees, because as you can all imagine, if an employee or maybe even 2 employees decide to go on leave at the same time, what does that mean for your business? There's really no true advice, but they have said that if you're going to hire temporary employees to cover for those 2 missing employees, it's just a best practice to be honest and transparent with that temporary employee that their job's probably not going to be there forever when the current employees come back from their leave types. So I've just moved through a couple things very quickly. The last piece of the state's legislation that I'll cover is the plan design. So to quickly recap, eligibility, essentially all part-time and seasonal employees, as long as they're hitting that $2,500 threshold. We talked about the leave types, so the employees can use it on themselves for their injuries and illnesses, for their family members' injuries and illnesses, as well as safe leave. Now let's talk about the product. If any of you do have experience with disability, you'll probably understand that a little bit more easily than what you will here, because where a disability is a 1%, such as 60% up to a maximum, very easy to quantify that. This has a couple of moving pieces. In fact, I'm not even going to try to read these first 2 bullets because I'll always tongue twist myself. And rest assured, there is a link to the state's website that has a benefit calculator. Because as you're all struggling to read this, it's even harder to mathematically work it out. So I would refer you all to the state's website to input your annual income or your hourly rate, and the state's website will actually kick out the estimated benefit for you. It does have a maximum of $1,100 in weekly installments. So these are all going to be paid out weekly paychecks, such as an STD policy. That $1,100 is subject to change because it's tied to the state's average weekly wage. So if inflation increases and incomes follow, that maximum is going to increase. If a recession happens and incomes drop, the $1,100 will actually shrink. But what it means today is if any employee makes $85,000 a year or more, they're capping out that $1,100 weekly installment. So $85,000 is where the cutoff is. It is designed similarly to workers' comp in the fact that lower income employees will get a higher percentage replacement than higher income employees will. Elimination period is insurance lingo for waiting period. So how long do these employees need to wait before they're eligible to receive payment? As you'll all see, 0 days is a very strong product, but I did say a key word there in eligible to receive payment. Keep this in mind because just because they're eligible to receive it doesn't mean that they're actually going to receive it. So I do believe there's a little bit of guidance left to be advised from the state in the sense of advance notice that employees must give employers. Because if I think about this on 8 a.m. on Monday, if 3 of your most important employees all file a claim at the same time, what does that mean to the success of your business? To that, I don't know. I do know that there's a process that they'll have to follow, whether it's through the state, whether it's through an insurance carrier, and there's always the event that a claim is denied. So in the hypothetical that an employee files a claim Monday morning, 8 a.m., and they take that whole week off thinking they'll be approved, but lo and behold, the state's actually going to deny it. That employee is out those 5 days, and it's back on you, the employer, as to how you'd like to treat that. You can have them use PTO, you can have them go unpaid, but in that regard, there's a check and balance that employees can't just file a claim, walk out the door, and expect to receive money the next day. My advice would always be to have that employee work until the claim has been approved or denied so that they're on the same page as you moving forward with the best way to go about this. The max duration of this product, I've gotten a lot of questions around this specifically because as you'll read, up to 12 weeks in a 12-month period. 12-month period is very important here because if you do have a medical plan or a dental plan, those maximums are most likely set up on a calendar year basis where December 31st to January 1st it resets. So if you're using all of your benefits, you would probably try to use all of them before December 31st comes. So in that way, if an annual or calendar year schedule is different than a 12-month period. And what I mean by that is this is 12 months, 365 days must pass from the date of the first filed claim for that employee. So again, I think it's easiest to understand with examples. March 1st, 2024, employee hands you their first claim. Maybe they only use 2 weeks. They don't get a fresh 12 weeks until March 1st, 2025. So 365 days have passed. So what that eliminates is an employee thinking that they're going to use 12 weeks to end a year and then a fresh 12 weeks to begin the next for 24 total consecutive weeks off. That is not the case. And in that sense, it is a check and balance again. And I'm only saying that because a lot of people think this is very, very rich and is something that they should be concerned with in terms of employees using the product. I mentioned employees can use 2 weeks, 3 weeks, 5 days. It's up to the employee as to how they'd like to go about this. They could use it as incrementally as they'd like, as long as the claim meets the contractual requirements. It's not up to you, the employer or the insurance carrier or the state to say, you need to use the rest of your benefit now, you need to use less of your benefit now. There's going to be limited reporting on this 12 weeks, whether it be through the state or through the insurance carrier. And what I mean by that is if an employee uses 6 weeks and 3 days of their benefit, and you, the employer, call the state and go, how much does this employee have left? You're probably not going to get an answer. So that's on you, the employer, to keep track and monitor, because that's very limited insight that any party is going to provide, because everyone's going to view that as an absence management or an FMLA service, which is a key difference between the Colorado Family product. Last bullet here, there's an extra 4 weeks if the mother has any complications relating to her pregnancy or childbirth. Again, I said mother because paternity leave is covered, but they'll never qualify for the extra 4 weeks. It'll only be up to the moms. Take a quick moment to pause before we jump into cost, which is a very important item to discuss, but I don't want any of the product itself to be swept under the rug. Okay, well, seeing none, I'll progress. As you all might be familiar with, the state has segmented employers between small and large at the number of 10 eligible. Under 10, I don't have listed here because as the employer, you're not on the hook for any contributions. If you have less than 10 total employees, your Colorado employees will be responsible for 0.45% of their own wages. If you'd like to subsidize that for them, you certainly can. You can split it in half, but at a bare minimum, you're not required to contribute anything. When you start to hit that 10 employee threshold and more, that's when the employer budget comes into play. And with the state, you, the employer, are responsible for half of the cost. So 0.45% of all of your Colorado payroll. And your employees would pay the remaining 0.45%, totaling 0.9%. It says premium, but I'll get into a little bit later as to why it's not essentially premium as much as it is a tax. But that 0.9% is all derived from payroll, and it's up to the Social Security tax, Social Security cap, which in the year 2023 is $160,200. So if you or any of your employees make more than that number, you'll only be taxed at the 0.9% up to that figure. Very important to keep this in mind when we start talking about the flexibility, the private side that insurance carriers are able to bring. Again, I'll quickly touch base on everything. Part-time seasonal employees, Colorado employees only, use this product on themselves, family members, for their own injuries and illnesses, for their family members' injuries or illnesses, 0-day wait, $1,100 weekly maximum, with a 12-week benefit duration, used as incremental as the employee would like. At this point, I'm going to pivot over to what the insurance carriers are able to provide. And I will tell you, obviously, I'm on the carrier side, slightly biased. There is good reason why as insurance carriers have stepped into this market to provide alternative solutions. I'm going to talk specifically about what Principal's doing and the advantages it gives you. But before I do, every insurance carrier will have different requirements. And before I talk about these, the reason we have requirements is because this product at its earliest is 5 years old in Massachusetts. So where Principal's been a life and disability carrier for 100 years, we have all that data, all that experience, and all that information we can use to forecast and look to the future as to what it will do. We just don't quite have that with this new product. No one does. We're all in the same boat here. But if you do want to look into a Principal solution, here's what you can keep in mind. We're going to mirror the state's plan design. Everything I just talked about is the exact same product you'll get through Principal. And I will speak on behalf of the industry. I think everybody's in the same boat. The state said that an insurance carrier can make enhancements if they'd like, but at a very minimum, they have to offer everything that the state is. I again think we're just early on enough that no one's able to make those enhancements. So you're getting a true comparison of the same products, whether it be through the state or through a carrier. Principal's only providing a fully insured solution. So if you do want to get the full understanding of the private sector, you also have the ability to self-insure. Because Principal's not offering a self-funded solution, I don't have any insight here listed on the PowerPoint, but there are some additional requirements you'll have to adhere to if you want to move forward in that direction. The first of all is a surety bond. I don't know exactly what the liquidity needs are, but I know that they are listed on the state's website. Work with Gary if you're interested in a self-funded solution being the best fit for you. We need 10 or more employees in Colorado. That's when the employer begins to have to pay. That's where we're going to want to start offering this solution. Again, I think the majority of the industry is at the same spot here because of where the state has set the rate at. We also will need one or more qualifying insured product, and we'll need that additional product to be enforced by January 1st of 2024 or earlier. So when the benefits roll out, that's when we'll want this extra product. That'll be a voluntary life, VTL, so life insurance offered on a group basis, not impacting the employer budget, dental, vision, or LTD, long-term disability. Again, the same thing that I mentioned earlier. You can think of this as collateral. We are an ancillary carrier first and foremost, so I certainly don't think of this as a negative. In fact, I think of it as a reason to round out an employer's employee benefits offering. But keep in mind, everyone is going to be offering the same products or have similar requirements in the sense of they'll need a little bit more skin in the game to offer this paid family medical leave solution. We will require 100% participation of Colorado-based employees, as will the state. And we're going to underwrite every employer based off of you, the employer specifically. What that means, as I just mentioned, that 0.9% is the rate every employer with 10 or more employees will have to pay. Gary can attest a 10 employee attorney group, 100 employee long haul trucker, 1,000 employee hospital. I just listed 3 incredibly different risks, different sizes with different underwriting, but to the state, they all got the same price. That's one of the reasons why we're able to step in and provide some solutions, because yes, that could potentially mean we're offering less than a 0.9% rate that you'd be getting through the state. Here's a little bit more understanding of what we're doing. So that 0.9 rate, that's called a premium through the state, as I mentioned, is a tax because the state doesn't have any reserves. So they don't have a pool of money to pay employees' claims. So they're funding this through the entire year of 2023 through your taxpayer dollars. Again, the product's not even eligible to be used until January 1st of next year, which is what Principal is offering. Don't give us a single dollar of premium until January 1st of next year when your employees can use this. Don't pay for a product you can't use. So avoid pre-funding with the state. A little bit more insight to this. You're probably all familiar with the fact that you just paid your first quarter of taxes. You do have a 30-day grace period from April 30th extending through May if you haven't yet. But what that means is from the date your exemption letter has been submitted, you'll be automatically approved for all remaining 2023 taxes. You'll then have the ability to apply for a reimbursement of all previously paid taxes. So whether you make that decision in 3 weeks or in 3 months, you can think of it all as a net neutral, $0 to Principal, unless you want to stay with the state. You'll have to pay that tax to build up their reserves and fund their solution as part of the whole system is designed for. There is a $500 application fee that you'll have to pay when you opt out. So again, it's payable to the state. You'll be avoiding all costs less the $500 fee. Ancillary and PFML, paid family medical leave, because Principal is able to provide both of those solutions, we'll house them on the same portal. So it'll save you an additional login, an additional set of numbers, phone calls, emails to send. You'll have the same consolidated portal. You'll have the same local team, and you can work with Gary on all of your as-need basis. So what that'll save you, and what we're hearing in the industry is, we want you to focus on your business. We don't want you to focus on paying bills and making sure censuses and eligibility is all accurate. So keep it all consolidated. You can audit one bill every single month to keep on top of your expenses and make sure everything is accurate rather than segmenting everything out. We also are going to provide some very strong administrative benefits. And you might remember when I had said the employees are eligible to receive payments on day one, but it doesn't necessarily mean that they will receive payments on day one. And what I mean by that, the state doesn't have any infrastructure, process, or consistencies in place because they've never offered nor administered an insurance product before. So as they're building up their reserves, they're also building out their claims team and customer experience. What we know based on the other states is that that usually leads to delayed claim payment. And I'll draw on a comparison to Washington. They were 3 months behind paying claims. So again, these are weekly paychecks. And as much as we'd all like to think we have a 3-month rainy day fund, emergency fund, whatever you want to call it, I like to think of these employees, maybe even lower income employees, being in the most dire of circumstances, taking care of a sick mother or father that's about to pass away. And they need to worry about where their income is coming from because the state's internal team was so clogged up that they weren't able to issue payments until 3 months after that claim had been submitted, despite the fact that that employee was actually eligible to receive those day one. That's where Principal steps in again. We're an insurance carrier. If we don't pay claims, we're not in business. So keeping the employee experience top of mind is something I think we all have to do. Again, we're all in the same boat. We all are following these same rules, but the difference is what these employees will feel. It doesn't necessarily matter to them whether their 0.45% payment is going to the state or Principal, but what does matter to them is when they need this, are they getting the money that's due to them? We will require physician sign-off. I don't think the state has advised on what their process looks like, but I will attest to the fact that we're going to make sure it's a valid claim. We're not going to prove anything fraudulent or illegitimate without doing homework and getting that physician sign-off, whether it's on the employee or if it's the employee's family members, we'll need the physician to sign off on the employee's family members. Again, I'd like to be transparent in the fact that Principal is in the business of making money, as every insurance carrier is. So if you have any concern with employees receiving payment despite it not being valid, those are all alleviated with the private insurance carrier side. I did call on the fact that we're going to underwrite everyone individually. So what that means and what we've been able to provide maybe some of your competitors, otherwise this is an insight to the industry. You don't have to move forward with the state solution. We will take a look at the industry, the nature of business, the demographical makeup of your employees to issue you a rate that we feel is accurate. Because at the end of the day, who's to say 0.9 is where it should be? The state's actuaries team have set that rate, but we don't know exactly what that means long-term. What we do know is that if we feel the risk is better suited, we will issue a lower rate. So here are two examples of low rates for very good risk to Principal and what that means for a 2-year cost comparison. You'll see the asterisk on the Principal estimated cost in 2023, $100 application fee. Again, it's not payable to Principal, but it's not a true $0 from your budget perspective. So I wanted to make sure that was clear. You'll all see the payroll here is what derives premium. Because this is a 0.9% through the state of your payroll, I've included that this first client was $2.8 million in premium, paying around $25,000 a year to build up the state's reserves that they didn't have to pay. Then the rate we issued was low enough to equate to about $10,000. So you'll see the 2-year cost comparison is just north of $40,000 in savings. The bottom one is the same. It's a higher payroll, so it's a larger premium amount. We were able to issue a very competitive rate. So the 2-year cost comparison makes it essentially a no-brainer. More to this though, I just said, who's setting this 0.9% rate? What we know is that that's not necessarily going to stay the same forever. The state has given themselves the ability to increase their rate from 0.9 to 1.2 as soon as 2025. What that is a result of is usually because the state might not have been 100% accurate with how to price this. But because we have 4 other states to look at and see how they're running, the claims utilization, the profitability, the good risk, the bad risk, we're able to issue a rate we feel really confident on long-term. We're certainly not in the business of undercutting anyone's rates to jack them up 2 years later, but that might be what happens with the state. And that's because the first year these products roll out, it's top of mind for everybody. You've either been paying for it and you couldn't use it, or it's been talked about enough that, yeah, you'll probably use at least a handful of weeks your first year of this. And as a result, the state might look and see, yeah, we're not running as profitable as we wanted to. We need to increase these rates to get back to our bottom line. Again, it doesn't mean necessarily that they won't decrease in 2026, But the point I'm making here is there's a little bit more consistency to the fact that insurance carriers have a lot of data that we can pull from. We've made pricing adjustments, we've made formula adjustments because we want to give you a rate and we want to do everything we can to honor it. The last thing with the cost is, again, just to be clear, the state will require a 0.45% employer contribution. That's not quite the way they're advising small employers, private employers to use. So if you were to look into a private carrier solution such as Principal, and we were to issue you a rate of 0.6, the state is saying you can still have employees pay 0.45%, the same as they would through the state, but then you, the employer, are responsible for whatever's left over. So if we did use that 0.6 example, you, the employer, have your employees pay 0.45%, leaving 0.15%. So it becomes even less than a 50-50 split using a private carrier such as Principal. You'll always have the ability to pay for the whole cost, but on a bare minimum, you're not only saving all of 2023, but you're probably saving from the employer dollars in 2024. And long-term, I'm very confident to say you'll be making the right decision with where we're going to issue this rates moving forward. I know I covered a lot. I'm sure you all have questions that you might not have put into the chat yet. I'll keep my screen shared if I need to move backwards on any PowerPoints. But I did want to open it up to questions at this time. Does anyone have anything they wanted to talk about?
AJ, I just want to touch on a couple of updates from the state that has that's come through that I think might be some valuable information for everybody here. So one of the things that keep in mind, here's some important dates that you're going to want to keep track of. So we are currently in that grace period for the first quarter. Those are going to be due by the 31st of May. The state has started to approve a couple of private plans that are out there. Overall, there are 13 different carriers that have requested to get approval, and those are starting to come through. Employers can request paid premiums from 2023 if your plan is approved. AJ had covered that. We've already covered claims can start, in December for January 1 starts. So this stuff could come live to you in December, and then your contributions, as AJ mentioned, are going to stop once a private plan's been approved. So here's some more other dates for when premiums are going to be due to the state. So Q1 ends May 31st. Q2 is going to be July 31st. Q3 is going to be a very, very important one for you, and that's going to be October 31st. That's also your deadline to be able to get a private plan approved and to request reimbursement for the premiums that were paid to the state for 2023 for that. And then at the end of January is going to be the premium payments that are going to be due for Q4. But I think as you dive into private plan options, I think it becomes far more attractive as we move along. AJ covered that. This gives you just a quick sample of what the paid leave chart might be, as opposed to AJ had given you the dollar amount and where that would come from. This is a chart that the state has put out there for you. There's also a small business guide. So S Corps, C Corps. The state website has a tremendous amount of information that's available on the small business guide. And if you'd like a PDF copy of that, certainly you can reach out to me and I can get you a copy to take a look at that. We had gone through that. There is going to be an employer or a healthcare provider portal with the state that is going to be operational soon. So a healthcare provider is going to be able to go into the state system to provide their certification, if you will. We anticipate that being ready to go here at the end of the summer. So that's one of the other updates that they have done. As I mentioned, there's 13 other plans, other carriers that are out there. Principal has been a great partner of mine so far, coming through here, been very supportive of me, and I truly appreciate that, and has been a bundle of knowledge compared to the other carriers that I've reached out to on that. This just goes through a little bit of difference between FAMLI and FMLA. there is a bit of a difference. And as AJ mentioned, it is concurrent on the two different benefits. And this is the contact information for me. I can leave that up here just for a second on that. In terms of the webinar here, there is a question that has popped up. So let's head up to the top one. How do we sign up with Principal? Contact info. Becky, that's my info. That's right there. There is a quoting process that we go through. It's actually very, very easy. We just need a little bit of demographic information and wage information. I get that out to AJ. He generally has been turning these things around for me within a day or two, and we can get that out very, very quickly to anyone. Independent contractors. Elise, are you referring to 1099 contractors? I'm going to assume that's probably what you're referring to. Those people there, doesn't matter their designation, if they decide to opt in on their own under FMLI and pay the premiums to the state, because they're going to be by themselves, they can do that. They can manage their process and do everything. Barbie, I will email out a copy of this presentation to everyone afterwards on with this. AJ?
I saw a question from Carly come through.
Yep.
And I'm reading it when you talk about family and FMLA running concurrently, how can they do that when an employee has only been there for 6 months? Great question, Carly, because I'm assuming you're understanding that an employee needs to be there for a year before being eligible for FMLA. It's only for that year plus employee tenure that you can run concurrently. From the 6 months to the first year, so the latter part of that first year for the employees, they won't have FMLA available to them, but they will the Colorado family. So that won't run concurrently up until that point. Does that answer your question? I hope to take the silence as a yes. Yes, well, we have to have an additional 6 months then for FMLA job security. So yes, after the employee has hit 6 months and they go and file their first Colorado family claim, they have job security. Until they hit that first year when FMLA applies, that's when they would get the FMLA security. So there's a little bit of a difference here because FMLA and Colorado family are essentially the same. Colorado family has a paycheck tied to it. So if that were to be used first, they'll have job security while they're on that claim. When they hit the first year, then they'll have the job security for the FMLA. Does that make sense, Carly? Exactly. They'll have job security. The one thing that I wanted to piggyback off of Gary before I concluded my section was my advice to everybody here. If you're excited to move forward with the private carrier, continue to pay the state's fund, continue to do everything you are doing until your submission has been reviewed and approved from the state. And as Gary just outlined those dates, we'll pretend July 31st is the one we're all thinking about. Well, let's say you decide to opt out and move forward with Principal and you submit that July 20th. You might think, I've submitted it, I'm good to go. I don't need to pay this next quarter of taxes. But we don't know how long it'll take the state to review these applications. My hope is that it's within a month, but from what we know in the other states, there's no real way to tell how long it'll take. So if you were to have thought, yeah, we don't need to pay this next quarter, I've already submitted, but they haven't gotten to your submission yet, and you don't pay that second quarter of taxes, there will be penalties that follow. So continue to do everything you're doing until the state has notified you, you've been approved, you're good to go, you're exempt from your future 2023 taxes. At that point, there's a very key note. You have the ability to apply for reimbursement. So you're automatically exempt from future taxes. You've already paid into the state's fund at least 1/4, maybe even 2 by the time you make your decision. You can apply for reimbursement of what you've previously paid in. The state is not automatically reimbursing you. I don't know why they're not doing it the way they are future taxes, but you'll need to ask for that. Additionally, they're probably going to give it to you in a lump sum. So if you've had the employee's income split and you've been contributing half of it, the state's going to give you the whole amount of money back, and it's going to be on you to redistribute to each employee. Reach out to your payroll vendor if they're assisting you, because they'll probably be able to help you get that all retrofied and get everyone their money back for that matter. But it's just a heads up. It's not going to do anyone any favors with the way it'll most likely be returned, but it is according to the law. You'll have to redistribute every employee's income the way they paid into it the first time. Gary, that's all I really wanted to make sure everyone knew and was aware of. If you have any other questions for me, let me know. I'll hang on this call in case you want to cover a little bit more.
You bet. One of the things I wanted to just mention to everyone that's on here, with the state, all the carriers have great websites where the employee is able to go on and file the claim. The state is requiring that the employer file the claim. So now you can imagine if the state is behind, and the best example I can give is the unemployment insurance. And if you saw 9 News a few weeks ago, they're currently sitting at about 30% of the claims are taking 4 to 6 weeks, and everything else is outside of that range. I can't think of one employer, including myself, who wants to be dealing with that and have an employee coming back to me haven't been paid yet, what's going on? And you're having to continuously follow up with the state to find out what's happening with that claim. With Private Solutions, in principle, they've got a great website to be able to go on, file the claim. If people have questions, they've got me as a resource. They've got all their customer service, administrative departments, everything's all set up, easy to go. The employee can call, the employee can contact me, and I can try to get some answers for them. It really is going to help administration of this. Really, I look at it as a health benefit, not a commercial insurance product, but a health benefit to work with them. And so these are some of the things that I know certain industries historically have not done anything on the health space, don't want to offer benefits, don't want to get into the benefit market, which is completely understandable. This is kind of pushing you in towards that. So if you can get a better rate, better process, better service versus the state, to me, it becomes a fairly easy decision on which way to go. So I'll get off my soapbox on that.
I have a question, gentlemen.
Sure.
So sorry, I just figured out how to unmute me. So back to the independent contractors. So the reason why I asked this is, I have a restaurant. If there's anything taken out of the checks, they are, they don't want it. And I know these guys are going to just try and somehow opt out of it. And I know you're saying that it has to take 100% participation. Can they make themselves independent contractors and still work for me full time?
Keep in mind what a independent contractor means to the state. If independent contractors, and I've gone through this extensively because in the insurance space, 1099 is very prevalent. And my business attorney put it to me this way: if you in any capacity create their schedule, tell them when they need to work, really directing them in the work that they have to do, then they essentially could sue you, saying that you are an employer, they were an employee. I can't even go so far as having someone who's 1099 and telling them to use my agency's name in terms of promotion, that they're affiliated with my agency. I can't do that. I can't say, hey, I've got this trade show, I need you to work there, as soon as I make that requirement, they're no longer 1099. They can make an argument that that they're an employee. And he's told me, and by all means, talk to your business attorney yourself. I'm just going off my experience and what I've been told. The state is being very employee friendly in this regard. So employers have not been winning very many cases where someone's 1099.
Okay.
So it's your business decision. You're able to do what you like. I mean, at the end of the day, this isn't something that you're imposing upon them. It's the state that has forced this. And as a business owner, you're trying to do the right thing at trying to mitigate the cost as much as possible and the impact to them as much as possible. That's the way that I would present it to my employees. We just don't have a choice.
Yeah.
We're stuck.
No, I get it. I think that, my challenge is going to be, they don't want money taken out of their check. I'm sure they'll be happy that I'm paying into this, but they don't want money taken out of their check. And then, again, the fear is that they're going to ask for more money to compensate, to pay for that portion that's taken out of their check. So I just know they're going to ask for all the different possibilities of what they can do. So
yeah, and see, then they pay more in the tax when they earn more, right? So the full amount they're thinking they're not actually going to get. And depending upon what the wages are, and depending upon the income levels, I mean, what I think is negligible could be a big deal for anyone else. And I get that. But we can always the only thing I can do is help come up with options and then try to figure out what the best option is for the business and for the employees.
okay. All right. Thank you.
You're welcome. Were there any other questions that are out there? I see that we are coming up on roughly 45 minutes along here, and I want to be respectful of everybody's time. Feel free, my contact information is there. You can always shoot me an email and ask me any questions. If I don't have the answer, I certainly have enough resources available to me to get the answer for you. As AJ mentioned, this is certainly a little bit of a moving target still, as the state still hasn't completed their portal and done a number of things to help us fully integrate into a private solution, nor even their solution. They're just taking premiums and working things out as they go along. So I think with that, AJ, I think we're good. So
thank you again for having me, Gary. Thank you for everyone's time today. Great conversation. I'm sure there'll be questions that everyone thinks of after this call. So like Gary said, continue to run those through him. He and I work very closely, and we'll look forward to getting you the right answers.
You bet. All right, guys. You have a great rest of your day, and thank you. Bye.